Hi there, it's Jeff here with a look at the possible impact of Trump's tariffs on the UK economy. It's been quite a week. This is undoubtedly one of the biggest external shocks to the global economic and trading system that we've had for decades, certainly in my lifetime, and it's been a newspaper headline writer's dream in many ways. Here's the backstory, of course. Trump has introduced a baseline tariff of 10% on goods for all countries, including the UK, Brazil and Singapore, but significantly higher import tariffs on the European Union, 20%, on Japan, 24%, South Korea, 26%, and China, 34%, who have, of course, retaliated with equivalent tariffs of their own. And some countries in emerging Asia, including Vietnam, have been hit with huge tariffs of 45% or more. So what are some of the likely consequences of this policy decision? We assume it will be maintained. That is to be determined on the UK economy. I've got here the latest forecasts for growth, inflation and unemployment issued by the Office of Budgetary Responsibility at the time of the March 2025 budget. And you can see that there has been a downgrading of forecasts since their last one in the autumn of 2024. So GDP growth has been halved for 2025 from 2% to 1%. Inflation will be 0.6% higher, above 3%, according to the latest figures. And unemployment will nudge higher from 4.1% in the labour force to 4.5%. Well, these were forecasts made a couple of weeks ago, and they're probably already out of date. What impact will tariffs have on the UK economy? Well, the United States was the leading single country destination for our exports in 2024. But exports to the United States account for probably only just 2% of our GDP, whereas for the European Union it's closer to 3%, and in Germany it's more closer to 4%. Germany, of course, runs a big trade surplus with the United States. So in a sense, the European Union and Germany are a little bit more exposed in terms of growth to what's happening in the States. The UK actually runs a trade deficit in goods and services with the USA. We run a trade deficit in goods and a surplus in services. And in fact, the UK, nearly 2/3 of our total exports are services, including business and financial services. So perhaps the UK is less exposed for now from a deepening trade war, but we are not immune. It's undoubtedly the case. And at a micro level, sectors such as cars, steel, potentially petrochemicals, pharmaceuticals, fishing, mining and what have you may be particularly vulnerable to tariff changes. Now, Trump's universal 10% baseline tariff and those other tariffs we showed are expected to raise inflation in the States by over 2%. So if inflation goes up in the United States, that could then lead to some cost-push inflation for UK businesses and consumers who import American products. That will be amplified, of course, if the UK brings in some retaliatory tariffs. So here's a chart showing the total value of trading goods with the UK on behalf of the United States. The blue line shows US exports. The blue area shows US exports. The black area on the histogram shows UK exports or US imports. And you can see that the United States runs a trade surplus. The total value of trade in goods is over $130 billion per year. And that's been going up. We don't have the figures for 2024, but we can imagine in 2025 that figure will be lower if the trade war persists. So I wanted to show you this chart, which shows the value of trading goods exported from the UK last year. And these are the main visible, tangible goods that the UK exports. Cars and mechanical power generators, way out ahead, including boilers and things. Medicinal pharmaceuticals, third. Crude oil, fourth. Aircraft and other things like scientific instruments. So these are the tangible products that we export to the world. Cars, of course, being the biggest single export. And if we think about the car industry, this is the 2023 data, just under 60%. So most cars made in the UK are exported, and just under 60% go to the European Union. About just over 13% go to the United States, 9% to China. So the obvious first order effect will be on UK exports a 10% baseline tariff, 25% tariff on all cars. So that's going to hit UK exports to the United States. Jaguar and Land Rover already announcing a temporary pause or suspension of shipments to the USA. So a contraction in demand will hit output and might lead to some job losses, perhaps some plant closures. The United States is the UK car sector's biggest single market, just over £6 billion worth of cars sold in 2023. So prices will go up, of course, in the States. So a lot now depends on the price elasticity of demand for UK exports in the States. So if the tariff increases UK car prices by 25%, it may not, of course, but let's say it increases it by 20 to 25%, we have to work out the value of the coefficient of price elasticity of demand. Will US consumers still buy UK cars if they are significantly more expensive? And of course, UK exports will also be hit by a wider, broader global slowdown, including a weakening of growth in the EU economy dominated by Germany. And of course, the consequences will be amplified if the UK retaliates with tariff of its own. And that will add to cost-push inflation and higher prices for consumers. Globally, this is from the latest a bit of data published by the Kiel Institute just last week. They were trying to estimate the impact of these tariffs. They're not reciprocal, they are tariffs on production. And they think that the United States will suffer a 1.7% decline in GDP as a result of these tariffs. Globally, the impact will be just under 1% of world GDP. China gets hit quite hard. Japan and Germany, about 1/3% of GDP. And the United Kingdom probably shaving about 0.2% off our growth in 2025. So probably not enough on its own to lead to a recession. But given that growth is already weak, the OBR have already cut their growth forecast from 2% to 1%, and others are even more pessimistic, then it'll be a further weakening of the economic cycle. And then there are other sort of second round impacts. So a persistent and deep trade war will lead to a global slowdown, and that will have an effect on business confidence and planned investment. We are seeing, as you'll notice if you're following the news day by day, tremendous financial market uncertainty. I've got a chart to show you on that in a second. A fall in the value of stock market wealth, for example, affects pension incomes. The initial inflationary shock from higher tariffs, well, it's likely that world inflation will be higher this year than forecast. The key question there is that a transitory, one-off increase in prices, which will work through, or does it become embedded in the economic systems? Does it lead to wages following prices? Weaker growth over time will bring inflation down, so we'll get some stagflation and then inflation will come down. But weaker growth will also lead to an increase in spare capacity in the world economy, especially in key exporting countries such as China. So this can lead to a fall in the derived demand for commodities such as copper and oil. We're already seeing Brent crude oil prices fall, for example. And a broader slowdown might precipitate a rise in export dumping. So export-oriented countries might find they have spare capacity. They're not selling to the States. They may well try and find other markets to perhaps dump their surplus capacity, and that could lead to more trade tensions. The biggest danger for me is that a prolonged and deepening trade war with retaliation, tit-for-tat tariffs, could have a hugely negative impact on confidence and investment. That is how a trade war can lead to a deeper economic as well as a financial crisis. Just wanted to show you this chart. This is the VIX index, the volatility index. It's the most widely used measure of financial market uncertainty, and it quantifies it as an index market expectations of future volatility over the next 30 days based on options traded in the Standard & Poor's 500. Now, VIX score below 10 is considered low volatility. Any score above 20 is considered high. And I've shown you three peaks: the peak in the teeth of the global financial crisis in 2008, the next peak when the pandemic created global lockdowns and deep and steep cuts in output and trade and exports, and then you can see the third peak, Donald Trump's announcement last Wednesday on tariffs. So this is a really important chart to follow. We're seeing a lot of global uncertainty, financial markets trying to decipher, untangle what the likely consequences are as we move into this period of great uncertainty. There's no getting away from it. This is a story that we have to follow in the days and weeks ahead. There we go. Thanks for joining in. I hope you found this session useful. If you did, consider pressing the like button and subscribe to the channel for regular updates on this and other key economic issues. Thanks for joining in. Take care, stay safe, stay curious, and see you sometime soon.